Hello, everybody. Welcome to Chapter 25, Relevant Costs for Managing Managerial Decisions. Um, at the time of this recording, again, this depending on when you're watching this could have been, a year or two or whatever away from when this actually happened. I actually burned my mouth on the inside. I ate something that was super hot and it burned my gums and everything like that. So if I'm talking a little bit funnier than I normally am, I apologize. But that's why it still kind of hurts a little bit in there. Like the skin came off. I mean, it was really gross. But anyway, I digress, not to get too gross for you guys. Starting things off on the right foot here. Relevant costs are things that we're going to be focusing on in this, what we need to determine, and what is important for us to make our decisions. Um, First of all, we have to figure out what we need to define as far as our decision is. What is our decision? Identify our alternative actions. What basically can we do other than what we're looking at doing? Collect all the relevant information, select a course, and then analyze that decision. Remember, we're always trying to look back at how we can improve. It's not so much as to point fingers or blame, which is something that I think we as human beings have an inherent desire to do, but we need to try not to do that. Our focus should be just improving. We're not all going to be perfect and make the right choices in the right circumstances and the right decisions in the right time frames. I mean, you think about all the decisions people made prior to COVID. When COVID hit, people's decisions that they made was something that was going to be very challenging to them because they didn't expect it. So all their decisions would be wrong, and that's why we're trying to make this decisions correct. We need to look back at what we could have done differently. Relevant costs are important to understand and know because without them, we're not going to be able to make an accurate decision. Incremental costs, incremental revenues, things that are going to increase as a result of our decision or decrease as a result of our decision. So we need to figure out which, when we are making that decision, what's going to increase our income. Keep in mind, income is different than revenue. One other option might give us a lot more revenue, but it also might give us a lot more costs, which would make a smaller income. We're looking which one makes us the most money. And we also have to consider other factors that are not just financial. Um, and I'm just throwing this out there. It's just something I'm making up. But if you're a company that could do something and make us trillions of dollars, but would destroy the environment, do you do that? Probably not, because even though you might make a ton of money, there's a lot of negative repercussions from perception, public opinion, as well as governmental fees and fines for doing that. So it's not always about the most income, but for the decisions we're looking at, we're assuming that our decisions aren't going to impact other people in a negative way, cause us to have lawsuits or fees or fines from the government. All right, relevant versus irrelevant costs. Now, as we've already gone over the CBP case, we should remember that sunk costs are costs that are just already incurred and it doesn't matter in the decision that we're about to make. So in our CVP case, we had those sunk costs regarding the costs that were already incurred before the decision um, needed to be made. And so we're going to have to, we don't care about those. They're not going to change what happens in the current situation or in the future. Out-of-pocket costs requires your outlay of cash. They are relevant, but I'm not so sure that we're worried so much about out-of-pocket costs per se, although we do need to consider working capital and other costs that we might need to front and have cash to pay for in that period of time. Opportunity costs are the costs that we would lose by choosing another alternative. So if we decide to make if we're harvesting peanuts and we decide to, instead of just selling the peanuts as is, we decide to make peanut butter with that peanuts, then our opportunity cost is the revenue we would have derived by selling the peanuts to a third party. Just that simple, okay? That doesn't mean that an opportunity cost is a bad thing, because if we chose the route that's going to give us the better income, of course, yes, that's an opportunity cost, but we're going to make more money, so we don't care. It's just being able to identify what costs are out there and what it's going to cost us essentially if we don't choose that option. And then avoidable costs are costs that can be eliminated if we choose one thing instead of doing another thing. So all those last three we discussed, out-of-pocket opportunity and avoidable costs, are all relevant to our decision making. All right. Let's talk about make or buy. Make or buy is, I think in the last lecture, I talked about the two departments and their option to either purchase from the internal segment that could provide LCD screens to the phone company or the phone segment of the company. Um, that's kind of the decisions we're going to be looking at here. Should we, as the phone company, should we look to have or if we're looking at the whole and we're a phone company, do we make those LCD screens or do we go out in the marketplace and buy them? These are the decisions that we make for as managers, and we're going to get into more of the decisions here too. So let's look and see what example they've given us. Um, Fast Track currently buys a key part for $1.20, and it doesn't tell us what part. It doesn't really matter. It can be whatever you want it to be. The cost to make it is $1.05 and includes direct materials, direct labor, and incremental overhead. We got to make sure it doesn't give us total overhead, because we have to understand that a new product will increase our overhead by a certain amount, and so we've got to estimate that, and that's what we're only going to put in there is the incremental portion, what increases based on our decision to do this. For example, some overhead might be, let's just say, depreciation expense on something else that we already have. Um, that's actually a really bad example. I'm trying to think. Indirect materials. Think of the indirect materials. Okay, that's what we should do. Indirect materials we're going to have to make this product. It's only going to increase it by the amount listed here per product is 20 cents per product. So to be able to do that isn't going to impact. It's going to impact our overhead, but we're not going to factor in all the other overhead that we're already accounting for because it's already there. It's a sunk cost. We already know we're going to have it incurred whether we do this decision or not. So we determined that these direct materials, labors, and overhead is going to cost us $1.05. Okay, so if we decide to make this, we're going to save 15 cents a product. Now, this may not sound a whole lot by per unit, but if we're making 100,000 of these a month, it adds up. But other factors that you might need to consider too is that these are estimates. How comfortable are we in saying that it's going to save us 15 cents per LCD screen to make these internally? What are some other things that we may not be considering? Are we considering, now these again are incremental overhead costs, the need for increased employees, thus new HR people to help cover the new employees if necessary, maybe some additional accounting. I mean, you're going to have some other costs, not to mention we talked about the variances in our direct material and direct labor. Is our direct labor variance going to be impacted? I mean, if we're over on all those variances by so much as 15 cents per unit, all of a sudden this make decision has been a bad decision. So keep in mind that these analysis that we're doing is based on estimates, and it could still be, even though we're saving 15 cents, still could be the wrong decision depending on how it performs down the road. But we don't know. We're only giving it our best shot. So now there's another example about selling and processing further the products that we have. This is the peanut butter example where I don't know that it's giving us the peanut butter example or a peanut butter example, but companies have to determine, like for example, a peanut butter company. Do you buy or do you get these peanuts as you harvest them? Do you sell them or do you process them further into an additional product? That's the question that you want to ask yourself as a manager. And you look and see all the costs that are going to be relevant to this decision. So if you're a peanut harvesting company and you're determining whether or not you should make these into peanut butter or sell these as peanuts just to whomever that'll buy them, You have to look at the incremental income and the incremental costs. What is going to increase because we're deciding to process this further? Well, let's do indirect materials. It's going to increase because we're going to have to include a whole bunch of butter and other ingredients that we're not used to making. We're probably going to buy some equipment that we're going to need to process this further. But maybe we're going to make a lot of money. And so we're going to look and see all the costs we can identify and then take the revenue we estimate we can make, subtract out the costs, and that's the revenue that we're going to make on this product if we process it further. So we compare that to what we can just sell it as. So if we're able to make this peanut butter and make $1 per container, that's pretty good. But if we can sell the peanuts and make $1.20, well, I think that making the $1.20 would be better because not only are you're just selling it and you're done. You don't have to include all these new employees, new equipment, all this other headache. But then again, maybe you do. And this is also another question you have to ask yourself too, which I think we covered in chapter 24 a bit, is what's our capacity? Are we operating at capacity? Are we using all of our fields to their maximum potential? Could we harvest more peanuts, still sell as much as we've been selling, and maybe in addition to that, do the peanut butter? I mean, these are all relevant decisions that we need to determine when we're evaluating a sell or process further. So here's your analysis, sell as is, process further. We look here and see that if we process it further, we're going to have 70,000 of income. As if we sell it as is, it's going to be 50,000. Our incremental income is going to be, we're going to process further and sell the item, we're going to make $20,000 more than if we just sold it. Remember, we're not making that 70,000 because that 50,000 we would have made with just selling it as is. All right, sell or process further again. Here we go. The 30,000 of previous incurred costs are excluded from the analysis. These costs are sunk costs. I don't know that they gave us 30,000 anywhere else, but whatever. But yeah, if there were $30,000 to just harvest the peanuts and everything, then yeah, those are not relevant because they're sunk. Regardless of whether we sell or process further, we still have to harvest these peanuts in order to make this decision. All right, scrap or rework. Now, in Accounting 111, we talked briefly about inventory, and sometimes our products would come back from our merchandiser or our retailer broken, somehow defective, or whatever. And so the question is, what do we do with those in that inventory? Do we just scrap it and sell it for scrap, or do we rework it and sell it again? This is how you get refurbished equipment. This is exactly the decision they're making. Do you just take that, let's say it's a computer, and do you just scrap that computer, rip it apart, take the parts, and just, go do something else with it? Or do you rework it, find out what was wrong with it, fix it, make it work, and then sell it as a refurbished computer? The option's yours to determine how much each option would make you. In this case of this example, we have revenue from the scrapped or reworked units. We get 4,000 if we just sold it as scrap, or 15,000 if we rework it. The costs of the reworked units is 8,000. So scrapping's $4,000 of income, rework 7,000. So our incremental income is going to be $3,000. We would make $3,000 in addition to what it would cost us to just scrap it if we I want to keep saying if we reworked it. I keep trying to say, and I'm stopping myself, we worked it. I don't typically have that speech impediment, which is kind of funny, which is probably maybe my burned mouth. I don't know. All right, so let's do the video word for right now, because this lecture is very short because there's not a lot to cover in chapter 25. Chapter 25? Yeah, chapter 25. I already get my chapters mixed up. Our word today is sugar. SUGAR, Sierra, Umbrella, Golf, Alpha Romeo. Sugar, SUGAR. Please make sure you put that in the video verification assignment so that you can get credit for watching this video. All right. Sales mix with constrained resources. So we don't always have all of the resources available. We have to determine what can we do with the items we have. We can't just keep making units because at some point we're going to run out of inventory. We don't have an unlimited amount. So what do we got to do? When a company sells its products, some of them are going to have a better profit margin than the other ones. And we got to look and see how many of those we can realistically make and sell, and then try to fill the capacity of each plant or wherever else we're working with the remaining products that we're selling. And we try to work from our most profitable to our least profitable down. Um, and that's pretty much what this slide says. And we want to look at our contribution margin per unit of the scarce resources to make sure that we can cover all of those products we want to sell and make with that. Now, let's keep this in mind too. Let's just think about this from a career standpoint. If you can be somebody that can find inefficiencies in processes to have these people with scarce resources make more of the product with the items they have, you're going to make a lot of money. One of the things that a lot of these companies do when you order or buy from like IKEA, these you put them together yourself type furniture and stuff, they have that down to a science to the point where they've maximized their wood to where there's little if any scrap. I mean, they get these things in so much size. They've accounted for the width of the blade that cuts everything. I mean, it's just down to the nitty gritty. So if you're good at that, if you're good at able finding inefficiencies and how to make processes better or how to maximize scarce resources, you are going to be in high demand and make a lot of money. Okay. So something to consider. Again, this is an accounting type job slash managerial, but I doubt that anybody who could do that would not have at least a good amount of exposure to accounting to be able to do that. But there are some naturals out there. Um, so when resources are constrained, we want to look at the sales mix. Basically, we only have a certain number of machine hours. We can also look at it too. We only have so many labor hours. We can't, we're not going to be able to sit here, even if we have these conveyor belts working 24/7, we still are constrained by time, 24 hours in a day, 7 days a week, no matter how many shifts we have. So, um, we got to look and see what's our maximum potential here. We look and see which ones are most profitable there, and it looks like it's going to be our max. What is this? It's scooter or something? Yeah, scooter. So our max scooter is going to give us $200 contribution margin. So we want to devote as much of our resources and time and energy into that product. Even though it takes us longer, we want to make sure we make the most out of that. And then our machine for pro is 1 hour. So these things are we gotta focus on and see what is our perfect mix. Okay. Produce the model that yields the highest contribution margin. Oh, per unit of machine hour. So I said initially the max one is their contribution margin per unit, but we want to see as a measure of our units per hour. So because our pro is a higher per unit uh, or contribution margin per machine hour, we're going to want to make more of those when we're looking at it from that standpoint. So I kind of got a little lazy there in my brain just looking at that second one, the contribution margin. But when we factor in the number of hours it takes, then we need to make sure that we, it's good. We're going to make with the max $100 an hour, whereas we're going to make 150 with the pro. So we want to focus on the pro. So looking at the pro, we want to say this is with unlimited demand. It doesn't give us one for constraint. Very nice, people. Well, if it's unlimited demand, unlimited demand, I'm sorry. Then we're gonna sell all of what we want in the pro because it's gonna make us more money. Okay. But you're gonna have people like me that's like, I don't want the pro, I want the max, I want the better one. So you're gonna have some limited demand as far as the sales mix goes for that. Okay, but if our demand is constrained, limited demand, we got to figure out how many of the units of the Pro that we can sell. And here it says 1,200 units. All right, well, then let's make as many of the 1,200 units as we can. Then we're going to look and see how many we can fill in with the Max. Okay, we're going to have all of the units that we can make to up to our capacity at our plant. Demand is limited. Produce the most profitable product up to a point of total demand, and then fill with the latest capacity or the remaining amount. So right now, I think the Xbox S or X is like the latest and greatest thing. And so what Xbox should be doing is producing as much of those as they can, and then filling in their time with the Xbox One. Whether they do that or not, I don't know, but that would be what would make sense. Knowing the limited amount of Xbox S's and Xbox X's they have, my guess is they're not doing that. Or if they are, then they have a whole lot more constraint on the hours that we know of. So, all right, segment elimination decisions. We touched on this a little bit in chapter 24. Let's go and dive on into it. Avoidable costs are what we're looking at in this situation. We're only going to be looking at what its avoidable fixed costs are. And this says here, a segment is a candidate for elimination if its contribution margin is less than its avoidable fixed costs. Let's just get into that and let's look at this. So here we have, before segment elimination, we have all these costs that we have assigned to it. As we look at all of these, the treadmill company has $10,000 loss. Your first instinct is probably say, well, let's get rid of it. But let's look at what was assigned to them as fixed cost. It was $15,000. By eliminating treadmill, you're going to have to allocate those fixed costs to the other units. And so you're going to see an overall drop in the total by $5,000 because that was the actual contribution margin that treadmill was giving towards the fixed costs. Even though they experience a loss in this segment, they're going to need to stick with it because they are contributing to the overall fixed costs. Now, the only option that wouldn't be true in is if they those fixed costs were incurred because of the treadmill. All right, and that's what we'd have to do. So when we come over here and we look, when we just get rid of treadmill and we have our wellness and fitness, our total goes down to $94,000. So it looks like what we've done, we dropped 1,000. So I'm guessing about was it 11? No, not 11. Sorry, 14,000 of these were fixed costs that were assigned to treadmill, but 1,000 of these would be ones that would have to be spread out amongst the other ones. So I'm looking at variable costs. Let's just compare those. So variable costs are going to be the same for the wellness and fitness. So now we're going to have fixed costs and fitness increase their fixed costs, and we're at a worse situation than when we discontinued our treadmill operations. So see, yeah, here's the 11,000. Okay, so they dropped they eliminated $11,000 of fixed costs that were associated with the treadmill company, and thus we're able to get rid of those. But there was still that $4,000 of costs that were assigned to the other segments, and so we couldn't make it to where this was at least a zero or a positive number. If it's a zero, you can keep it around. Not getting rid of it's not a big deal, but if it's a positive, you definitely want to get rid of it. Okay, if you're gaining money, gaining income because you got rid of a segment, then that's a good thing. Evaluate, keep, or replace decisions. All right, keep or replace. What should we do with the plant asset? Can it still keep going? And if it does, is the capacity and the extra work we got to put on it going to make it worth our while, or should we just buy a new one to keep going with that? So we look at this and we see how much longer we're going to be using it for. We factor this all in. To keep it, it's going to cost us about $250,000 of manufacturing costs. I'm trying to find where they're getting this at, remaining useful life. So we're looking at, okay, it's the $50,000 of operating costs times the 5 years. And then we're going to look over here at our new machine and we're going to take the sale, add that to it, but then subtract out the purchase of the new machine at 100,000 and then our new variable manufacturing cost per year. And that should be 50 minus 36 times 5, but I don't think it's doing 36 times 5. Oh, yeah, that's because that's what we did last. I'm sorry. So yeah, so it's going to show that we have a $5,000 incremental cost. So because it's a cost, we don't want to replace this yet. Okay, maybe next year. Maybe next year. Product selling price. This is important and probably something maybe I should teach to you guys before we do the Lego project. But how much do we sell something for? What do we have to account for in this? Here's, what does our market look like? Can we control the price, or do we have to follow the market because we have too many imitators out there? For example, we look at Coke and Pepsi. Okay, they're two similar products. I don't care what anyone says. Coke and Pepsi, they both taste like crap. Um, but you have people that swear by either product. But can Coke say, well, ours is superior to Pepsi, so we're going to charge $2 a can as opposed to Pepsi that charges 75 cents a can? Well, they could, but they're going to lose a lot of customers that are price. Um, Crap, I'm trying to remember my economics. Price elastic, to where we basically say, well, if you increase price, I'm going to your competitor because I have no loyalty to you. There are some that do. Like my loyalty is with Dr. Pepper. Good stuff. So anyway, those are the things we have to evaluate when we look at this. Um, Cost plus methods. Um, when the companies are the price setters, we get to kind of set the price. We take our total costs. We're going to divide that by the number of units we expect to be sold and produced. And then we want to have the markup. So we're going to have that, and then we're going to add that to our total costs, and that's our selling price. It's just that simple. Okay, and that's kind of something that people with more custom products can do on a regular basis. So those of us that don't have that custom situation is what I was talking about with the Coke and Pepsi example. Total cost method, you just take all your costs, throw it into a spreadsheet, and come up with a selling price per unit. This one's really, again, all of these depend on the estimated number of sales, except for the markup one. You've got to have a good handle on how much you expect to sell. Otherwise, your cost amounts are going to be pretty off. Now, I haven't thought about this until just now, but you can make a flexible total cost method and kind of see where you'd be at and estimate your selling price at that point. That'd be an interesting one. Say, hey, if I make this many, I can set the price at this. But when I say make, I also mean sell. When you sell a certain number of greater, then maybe you can have a cheaper price. I don't know. That would be an interesting analysis. Target costing method. Basically, you say, okay, I expect to sell this for $80 and I want to make $14 per unit. So I've got to make my costs at $66. It's just that, you got to then take all your costs and try to find a way to keep your costs down. This would probably be more what Pepsi and Coke have to do to make their stuff work. So. And then the variable costing method is similar to what we've already talked about on the total cost side, except we're looking and focusing on the variable costs only. So, special offer decisions. Again, this is one of those ones with capacities. So a lot of times a company may come to you and say, hey, we want to buy a certain number of your products. It might be a one-time deal. It might be something that you can do indefinitely. The decision you have to make is if this will increase income. If it doesn't, then you're going to reject it. But even if it makes a small profit, there's an option there that you can either accept or reject it. A lot of times these companies come to you and be like, hey, I want to buy this huge bulk amount. And so I want to be able to have a special price. I want it cheaper than everybody else. Okay, well, you look first, are you operating at capacity? If you're operating at capacity, you can't take on any more, especially at a reduced amount. So you say no. But if you have excess capacity and you have the ability to entertain this offer, then you would evaluate it. Okay, you come up with all this information that you see here, um, and then evaluate how much you expect to make. So in the past, we're going to sell them for $10 a unit, but this other company is going to want us to sell them to them for $8.50. So again, if we have excess capacity, we can do this. We can not skimp on our other sales and make this other one happy. Then yeah, we do it because we're going to make $1.80 for each unit we sell to them. So according to this, we're going to make $18,000. So why not? Let's do it, right? Let's do it. Um, if this were in the negatives, though, then obviously we wouldn't. And I would even argue if we broke even, we wouldn't do it because if you're not contributing even to the fixed costs. Why put yourself through that? Why do that to yourself? But at the same time, maybe you make a relationship with this company, and that's a good thing. I mean, there's other factors to do. I wouldn't want to do all that work though for no income. That's basically what you'd be doing. So. All right, that's chapter 25. If you have any questions, again, please let me know. Let's talk about it. Get to me early, get to me often, talk to the tutors, whatever the cases may be. But make sure that you put the video word in the video verification assignment in Canvas so that you can get your points for that. If you have any questions, let me know. You guys have a good one. We'll see you in the future videos.